Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kessling, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Hey everyone, welcome to the Absolute Return Podcast. On today's show, we welcome special guest, EquityZen Co-Founder and Chief Strategy Officer Phil Haslett. EquityZen is an online marketplace for trading pre-IPO shares of private companies. On the show, we discuss some of the hardest challenges he encountered building a marketplace startup, the opportunity for investors in pre-IPO shares, why companies are staying private longer, and private company liquidity, his number one piece of advice for entrepreneurs, and more. So with no further ado, here's our show on pre-IPO investing with EquityZen Co-Founder and Chief Strategy Officer Phil Haslett. All right, happy to welcome Phil from EquityZen on the show. We're going to chat about pre-IPO investing and all that good stuff. So Phil, how are you doing today?
I'm doing great. Thanks for having me.
So super excited to get into it today. Pre-IPO investing has been quite popular. You hear about massive private companies staying private for longer and longer. You think about, Amazon going public fairly early stage and Google as well. But now you have massive valuations behind OpenAI and SpaceX and companies like that. Now potentially going public at like $1 trillion valuation. So massive value creation happening in the private markets. And it's super cool that EquityZen is helping investors and allocators tap into that. Now, prior to getting into what EquityZen is all about, could you walk us through your career prior to launching the company, your career in capital markets, and then where the idea came from? What problem were you trying to solve when you founded EquityZen?
Yeah. Well, like a lot of people that end up in fintech, I had started out in traditional finance. And so I was at Barclays Capital for a few years. I was on a proprietary trading desk there. I focused a lot on really illiquid markets, mainly like credit default swaps and leverage loans and long-dated equity derivatives, and learned a lot about illiquidity, how to solve it through structuring, how exchanges and marketplaces would try to solve those things as much as somebody can in their first 3 years of their career. And, through a bit of serendipity, I reconnected with, a mutual friend. It's who's my co-founder now. And he was actually working on, at the time, trying to find some liquidity for his own shares in a private company he worked for. And so really he was feeling the pain firsthand of having illiquid stock kind of and this paper wealth problem. And he was telling me about it, and he was looking for a co-founder. And the problem resonated for me in the sense that I had worked with the liquid marketplaces. This was in a liquid marketplace. I knew nothing about venture capital. I knew nothing about stock options for employees. But clearly there was a willing buyer and a willing seller for something. And that just meant that there was structuring that could solve it. And so that was really exciting to me. And the idea of kind of getting out of the traditional kind of Wall Street path was compelling to me as well. Wanted to do something different, wanted to have a bit more autonomy and agency.
Makes a lot of sense in terms of the desire to become an entrepreneur and the opportunity set there. Now at the time, rewinding several years, there were some competitors doing something similar in terms of capitalizing on the growth of pre-IPO companies and providing or sourcing liquidity and creating a platform around that. How did EquityZen differentiate itself, and what were you really coming out of the gate at?
Yeah, well, I would say the first thing that's important to kind of set the stage is we started EquityZen in 2013. And in 2013, there were about 30 US-based unicorns, right? Companies that were worth $1 billion or more. Now, that number is in the thousands now. So the market has changed considerably. But at the time, there were a handful of incumbents that were effectively kind of like phone brokerages to help people get liquidity for their shares in private companies. They had platforms, they had websites, they had bids and asks, but in reality, it was a lot of manual work behind the scenes. It was all analog.
These were like old school bond trading desks, or I guess what they still have today.
Yeah. And honestly, if you think about a lot of asset classes that are really liquid now, equities, convertible bonds, CDs, treasuries, like when they actually start kind of illiquid, and the fees are really high, and you need someone to call and find a buyer and find a seller, and you get them done, and they're really sporadic. And then over time, they scale and they scale and they scale, and they finally find their way to retail, and the prices go down. And so pre-IPO is like not that different. It's just that we're in like the earliest innings, even though we're only like 15 years in. And so we just felt like if we could build a little bit of infrastructure around how these things worked, we could help standardize how people, sign their subscription agreements and move money around and did KYC, and could browse a platform and see different companies. We would be like light years ahead of what other people were doing. That was piece one. And then piece two is any pre-IPO transaction actually has three stakeholders. It has a buyer, it has a seller, and has the company that's issued the shares. Compared to buying and selling a share of NVIDIA, like you don't have to go to NVIDIA each time and say, hey, I'm going to buy shares, from Michael. Like you don't have to do that. But in private markets, you do. You have to get it kind of routed through. And so we learned quickly to have a constructive conversation proactively with the companies or the issuers themselves, right? To say like, at the time, hey, DocuSign or Coinbase or Uber or Lyft, how do you think about employee liquidity? How do you think about, retaining your employees by giving them stock options? We want to be helpful here because you're staying private longer. We don't want to be a distraction for you. And I think those two key elements, the tech and the dialogue with the companies, was what set us apart.
That's a really good point on needing the company's permission, because I've seen some instances, perhaps it was related to Stripe shares, where an institutional investor thought they acquired them free and clear, but the company's saying, actually, no, those may be void because you actually need our permission to trade these.
Yeah, that's right. I mean, Stripe has a naughty list, right? If you go to Stripe's like investor relations page, like you can see a list of, platforms they say that are purporting to have shares of Stripe that Stripe has no relationship with. So it is a bit of the wild, wild west out there. It still is, even though the market's like, grown a bit over the last decade. So it's, you have to do some research.
Certainly. Now, founding the platform in 2013, fast forward 12 years later, how has the platform grown and developed? And is it the same as your initial vision, or have you had a bit of a pivot or evolution along the way?
Yeah, I wouldn't say that we've really had much of a pivot. Our mantra when we started was to bring private markets to the public. And by that, we meant we wanted to bring this asset class to more and more people. And now it's evolved is when we started, it was really only an institutional thing, or if you were a founder, you can get liquidity. And it's evolved now to where, in EquityZen, you can put in $5,000 or you can put in $20,000 into a fund that has 20 companies, right? So effectively, you can get into a company for like $1,000, which is a big, big, big step forward, but there's more to do. So overall, no real pivot. Of course, the platform's like adopt or kind of evolved a lot over the 12 years. It started out with just 3 co-founders, and now we're 50 or 60 people, and it serves something like a couple 100,000 folks that come to the platform. So it's grown quite a bit. It's, in the process of becoming part of a bigger financial institution as well. So it's been exciting to watch it develop.
And marketplaces as a business model are great. However, launching them, getting the buyers and getting the sellers, and you, of course, have a unique problem in requiring company participation as well. It's really tough to build that from the ground up. So in the early days, what were some of the hardest challenges that you encountered?
Yeah, marketplaces suck at the start. They're really, really, really hard. You've had to... Outside of financial services, my advice for a marketplace would be kind of fake it till you make it, right? Like kind of convince one side to just stay there as to like build one side of the market. You can't really do that in financial services. Like that's kind of what gets you like disbarred, gets you in a lot of trouble. Also, if you're a financial services marketplace, you're at some point going to be asking somebody to send money to do something, right? And you want to have this digitally native experience. You want it to be super scalable. But I think what we learned is you have to do a very unscalable version of your business at the start to get your first set of customers, right? You've got to go call them, email them, meet them in person, convince them that like this is the thing you're going to actually take care of. You're going to be a good steward of their capital, and you're going to make sure that they buy the thing they really wanted to buy. And that was really, really, really difficult. And so it took a long time to kind of build up both sides of the marketplace. And we kind of did it hand to hand. So probably sounds a little counterintuitive to my early thing saying, if we felt like we had tech, like we would win the market. We still believe that. It's just to build the first kind of steps or lay the first planks of your business, you really have to do it in a very analog way. And that takes time. It's really, really hard.
Right. Now, say someone's listening to this and think the idea of diversifying into pre-IPO companies is a great idea. and they're like, okay, I want to go on EquityZen. Can you talk about the platform and what customers can expect? And in addition, what are some of the more popular opportunities on the platform?
Yeah. So going on the EquityZen platform, in some ways will feel like going into, say, a Robinhood account, right? Where you log in and you can browse different companies. You can look at research reports we have on individual companies themselves or on a sector or trends that we're seeing. It is now basically a fully digitally native experience. So you can go through, you can browse, you can go through an entire investment process by signing subscription agreements and obtaining your money information and going through KYC and AML. So you can do all of that. You can but you can also just browse. You can just learn about companies, because I think that's super important in our asset class. Is you hear about one company like OpenAI or Anthropic, and you get really fixated. But it's good to see what else is out there and what might fit your portfolio or your kind of investment profile, right? Inherently, the asset classes should certainly fall into this is a risky, illiquid bucket compared to everything else, right? Compared to public equity and public fixed income. And so, yeah, overall, we tried to make it more and more of an experience where you can kind of learn about these companies and make an investment online. That's kind of the main goal, and get educated, because there's not a lot of places to get educated on private companies right now. Part of that is because the companies inherently are private, right? So there isn't a ton of information out there. So we do our best to aggregate information about private companies from the public domain, kind of collate it, condense it, make it really succinct so people can evaluate.
And it does look like you're starting to offer something unique in the sense of some diversification across private companies. And so that, as I understand, that's from your multi-company fund product. And when you look at that product moving forward and the different areas of growth within your business, being a facilitator of secondary market transaction, but then on the other side, providing more of that diversified exposure through a few companies or themes, do you see that side of the business where EquityZen becomes more of a fund manager, a more impactful growth area, or which area of the platform, I guess, do you see the highest amount of growth for?
Yeah, it's a great question. I think the first thing I'd say that is the multi-company diversified funds that we offer, I think have been a great fit for people making like their first investment, or for a wealth manager that's looking for some type of, exposure to the asset class, right? You don't have to pick and choose what's the difference between Anthropic and OpenAI. What's the difference between the application layer for LLMs versus foundational LLMs versus the energy that's going into them. Like, the fact that you can kind of just like get exposure to it by a managed vehicle, I think is great. As far as where the market goes long term, right now, I think asset management doesn't play enough of a role in the space for pre-IPO investments. I think that's going to grow. But I don't think that the single company kind of trading is going away. It just really depends on each private company. Because again, each private company can kind of decide how illiquid or liquid their pre-IPO shares are, right? And some companies prefer that they never exchange hands, and they run the risk that they can't hire folks because people never get liquidity, and that's okay. Whereas other companies really embrace it and use it as a tool for attracting talent, retaining great talent, knowing what their shares are worth. And so each company is a little bit different, but overall, Michael, I'd say I think the trend is towards more asset management, not less, so that people can get diversified exposure. And I always like to think that the newer the asset class and the more retail the audience, I think that is a perfect mix for like a diversified product. Otherwise, you get people that just get burned.
And it certainly makes sense if you take the public market analog to just buy the index rather than stock pick. And I guess it's the same in the pre-IPO market. Now, with that, one dynamic that EquityZen and other platforms are reliant on is the dynamic of companies staying private for longer, which is a pretty new phenomenon kind of in the last decade or two, because previously, you'd have founder, employees, some early stage institutional investors, and then within 5 years go public and there's your liquidity. However, you're seeing so many companies stay private for longer and longer. Do you think that trend will continue? And is there a time when some companies never go public? Is that a possibility in the future?
I think it's a permanent trend where companies are going to stay private longer. As long as there is access to capital while you're private, the trend will continue. And as long as the costs and the burden of going public are high, companies will stay private longer. And outside of tech, there's actually a lot of companies that start as private companies and stay private forever, right? Like the largest electronic health record company in the world called Epic has been a private company for, 30 plus years. And Cargill's private and you have really big private companies that already exist. So I do think the trend's going to stick around. We've seen the number of publicly traded companies, at least in the US, go down by about a third over the last decade. Now, that does mean that you kind of have to have a better solution or a better mousetrap for the pre-IPO markets, like the private markets, because it's not perfect. There's no exchange right now, right? There's no universal syntax for things, right? There's no tickers, there's no QSIPs for any of these things, right? We're all using our own versions. So that infrastructure would have to get built out if this is going to be a permanent status. So I'm not sure which one's going to give, right? Are we going to make going public easier, or are we going to make private markets more standardized? I don't know which way it's going to go, but you kind of think about what the companies are going to decide what they want to do. And if they can continue to capital while they're private and with less scrutiny and more flexibility, they're going to continue to do that.
On the track of feedback from companies you described, Stripe's kind of how they've handled the situation and some of the pushback that you may see from the actual companies themselves. But something that isn't really talked about all that much would be on the VC side, and specifically within portfolio management for venture capital firms. How have you seen them using a platform like this in managing their own portfolio weights? Because you get these funds and they can, when they almost have the curse of the winner, where the entire performance of the fund at the late stages could be driven completely by their one winner. They may want to make some portfolio management changes. Are you seeing some of that being done with the platform?
Yeah, absolutely. I would consider EquityZen to be one of many tools at disposal of a venture capital firm when they think about liquidity, right? And your point is incredibly valid, because most venture capital fund life cycles are 10 to 12 years. Companies are staying private for, SpaceX is a 22-year-old company. It's older than some of my employees. And so when you've got that dynamic, those funds need liquidity. EquityZen is one way to do it, right? They can sell their shares to an investor that wants to come in. But there are other solutions like, creating continuation funds, selling strips of the entire fund itself, right? And that's not necessarily an EquityZen type solution that we provide. So consider us like kind of one of many tools, but it's an increasing mechanism being used by investment firms, to the point where I think a lot of funds had more liquidity, return to their LPs in 2025 through secondary mechanisms than they did through IPO or acquisition.
I was interested in getting into the composite members kind of on both sides of the marketplace, because primarily we've spoken about, employees and kind of individual holders sort of buying and selling. But do you have institutions, Mike mentioned, VCs potentially facilitating liquidity to exit? However, do you get institutional buyers on the platform in terms of sourcing those shares, whether they're crossover, private public type investors? Another pretty neat dynamic. I remember when Andreessen Horowitz started up, well over a decade ago. I remember they were actively going out and buying Facebook shares, which I always thought that was very, very novel at the time, because as a VC, you used to participating in fundraising rounds, not going out and buying stock. So how do you see that with the growth of pre-IPO platforms? Does the growth of venture capital and institutional investors playing in the space, has that helped kind of on the liquidity side, both buying and selling?
Yes, there is. It used to be a bit more taboo or kind of ad hoc that somebody like Andreessen would be buying shares on secondary, and I think it's become a lot more standardized or normalized over the last couple of years. In particular, from kind of post-COVID, there was a ZERP era where companies were raising money all the time. And huge valuations, and there was just a total flow of capital. And then there was a huge slowdown in 2022 through 2024-ish. And what happened was you had a lot of funds like Andreessen that wanted to double down on companies they believed in. And a lot of these companies said, we're actually not raising any more capital because, for one, we raised it way too high of a valuation before, so we don't want to take a down round. And two, you were nice enough to give us so much money in 2021 that we don't need any for a while, right? And so there was no longer a mechanism for a lot of these big, like kind of mega funds to invest in the companies that really wanted to through primary raises. So they went to the next solution, which is maybe we can buy shares on secondary. And so that created this effect where a lot of the crossover funds and venture capital funds started getting more active as buyers in space, to the point where now you see it relatively often. And that's certainly been, a big boon for kind of platforms like EquityZen.
So say you have buyers of pre-IPO shares on the platform, and there's several liquidity options, obviously selling on the platform as well. However, then there's IPO or a sale to a strategic buyer or perhaps a private equity buyer. What is the mix in terms of exit liquidity of buyers on the platform that you've seen?
Meaning kind of what's the ratio of like IPOs versus M&A, or kind of which type of clients do we have making investments?
Probably the former. If you're a holder you go on the platform, you buy some shares, what can be expected? Is it very rare to see an IPO and get liquidity that way? Are they disappointed? Be like, oh, we got an acquisition offer from Google or something, and it's not as high as I wanted. Like, do you see those often, or is it mostly just they buy and then several years later they just put up an offer and sell?
It's a mix of everything, honestly. We've been participants in really, really big IPOs over the years, right? Whether that's Lyft or Coinbase or CoreWeave. We've been parts of large M&A transactions as well. And also we've had offerings that were, parts of companies that sold for very little or zero, right? And so there's a distribution of returns. Fortunately, kind of in the late stage bucket of venture, you tend to have fewer complete zeros, right? Because companies have, actual like revenue pipeline. They hopefully have a path towards profitability. They are beyond product market fit. So you don't see as many, you don't have kind of the same dynamic you have with like a seed fund, right? Where, they make 30 investments and 25 of them go to zero or 20 of them go to zero. Things are a bit, flattened out. However, you still have some like that just go completely to nothing. They burned through cash. They were poorly managed. They tried to pivot, or they were impacted by, material change in the world that they were unprepared for, whether that was the AI rush, whether that was interest rates changing, regime change, political changes. So we see a bit of everything, but, most of the investors are making an investment where they're hoping to see some type of exit by way of IPO or acquisition in the next few years. And we strive to make those opportunities available with no guarantees.
And by make those opportunities available, at what point in time would you be looking to, for lack of a better word, list a pre-IPO company on EquityZen? Do you look as they reach a certain valuation, a certain revenue? How do you take that into account?
Yeah, we're typically looking at companies that have probably raised more than $100 million in venture capital and have a valuation in excess of $500 million. Tend to see that's when a couple of things happen. One is we think the company's been de-risked to some extent. Two is that there are actual needs for people to get liquidity, right? If you talk to a company that's 2 years old and it's only got 15 employees, there's an actual need for liquidity, right? There isn't this pent up supply. But as companies age and they get bigger in size, the paper gains get bigger, and the time that they were held becomes longer, right? And that's when you see like a natural need. And so we try to operate in that space. The reality, though, is like you actually have kind of like a long tail of companies that are very, very large in size, right? Like 5, 10, 15, at this point, $100 billion plus valuations that actually dominate a lot of the volume, because it's not necessarily like a flight to quality, but it's maybe the blue chip names of pre-IPO, right? Or names are there companies that people are really familiar with that are in the headlines all the time and seem like imminent potential IPO candidates. Those are the names that attract a lot of retail investor attention.
And I was curious about that because you look at public stock markets and the Magnificent Seven attracts like all the volume. And if you're a small cap issuer, like no one cares about you. If you look at the crypto markets, it's like, Bitcoin, then Ethereum, Solana, and then there's literally tens of thousands of others that don't attract a lot of volume. Do you see the same in the private market where there's, perhaps a Magnificent Seven type dynamic to it?
We do. And it really depends on where we are in kind of like a market cycle. In 2021, there was interest in a very wide variety of companies. In 2022, 2024, it was really just a handful of names. And then now we're kind of back into a space where it's like somewhere in between. Because also, there's a lot of enthusiasm about new businesses growing faster, companies who kind of almost reviving themselves with the advent of AI, right? How they can solve problems. And so you actually have a wider cohort. So it's not just the foundational LLMs. It's not just, Anthropic and OpenAI and Grok. It's or XAI. It's wider than that, right? It's a bit more dispersed. So there's always going to be interest in kind of the Mag 7 equivalent within private markets, but we're seeing a wider band of company interest.
And in terms of running and developing the platform and growing the listings and opportunities, what do you think is more difficult? Sourcing the liquidity from these opportunities or finding buyers, or is it kind of cyclical in between the two?
There's certainly some cyclicality, but generally I have this mantra about marketplaces overall, which is that the best supply wins, whether that's Airbnb with the best houses available, whether it's EquityZen with the best supply available. So in my opinion, being able to get, the access to shares in the companies that people are really interested in, I think is mission critical. And a lot of the rest of things of the platform will solve itself. I think if you go the other way and you spend a lot of time cultivating the buyer base, but not nurturing the relationships and getting unique supply, that's going to make your life tougher. Someone described venture capital as, the alpha is about access. It's like, how do you access the best companies? And I think that's actually still true for our marketplace. We happen to access them in a different mechanism, which is through secondary liquidity, right? We provide the service of getting liquidity versus trying to win a spot in like a primary capital raise. But I think it's about access.
Right. Now, in terms of growth and liquidity, one thing that's happening at EquityZen is the acquisition by Morgan Stanley. So congrats on that. Obviously, a huge public company there. I was wondering, with respect to that transaction, what comes next for EquityZen?
Well, thank you for starters. And, transaction hasn't closed yet, so we're not, completely celebrating. But, overall, we're really excited to be partnering with Morgan Stanley. They are, one of the biggest global financial institutions out there with a really large wealth management practice. And I think what we're most excited about is kind of bringing EquityZen to a much broader audience. That's always something we've wanted to do, and to build it ourselves would have taken decades to get to the level of scale that Morgan Stanley has created over the last 90, 100 years. And so for us, it's really just about the scale we can deliver to this marketplace and the ability to do it sooner than later. So we're really, really pumped.
And tapping into that distribution network, no doubt, will provide some phenomenal growth opportunities there. Now, Phil, before we let you go, just one last question. As you've been on this entrepreneurial journey for a while, what would your number one piece of advice for entrepreneurs be?
My number one piece of advice would be just that you can't predict what it's going to look like. And I say that because looking back on it, I remember when I started EquityZen, I kind of said, it's either going to be like this huge success or it's going to be a zero in like 2 years or 5 years or something like that. I had no idea what I was talking about, right? It's very likely going to be something in between, which is that it's going to be a roller coaster. There's going to be really a lot of emotions on the way up and a lot of emotions on the way down. But if you can find a way to just keep making your business better and better over time and doing it in a way that you're proud of, like you will get a result you're happy with. And don't expect it to look like anything you think it's going to look like. You just don't know. So just kind of embrace the uncertainty, keep your head down, work hard, and good things happen to those types of people.
Perfect. Well, Phil, we appreciate your time and insights today, walking us through EquityZen and your story as well. So wish you the best of luck in the future.
Thank you. And thank you both for having me.
Bye, everyone.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.